2021 has been a big year so far with big changes. And as we ease into a new administration, what does the future look like for your retirement plans? I'm Tracy Capelman. Join me right now for your Wealth Health. Hello and welcome to your Wealth Health, a show focused on helping you manage your money. I'm your host, Tracy Capelman, and I am here once again with Eric Brenner, a certified financial planner with nearly 30 years of experience. He is the founder and CEO of Hilltop Wealth Solutions. As a true fiduciary, Hilltop Wealth Solutions is legally and ethically bound to act in the best interest of its clients, always. Now, this week, we're going to discuss President Biden's $2.25 trillion tax proposal. We're all wondering what kind of impact it'll have on our retirement planning. So many people worried about big changes ahead, including taxes being raised as a result of this bill. And, you know, the economy is so volatile these days, it makes it hard for anybody to feel secure about their financial future. Now, we know that President Biden has proposed moving the tax bracket back to what it was a few years ago, but often these tax regulations apply to new income you earn that year, not your retirement funds. So, Eric, tell us, how much do people nearing retirement age really need to worry about potential tax increases?
Yeah, and it is a tricky question because first off, these are all proposals. So they're certainly got a lot to get through in order to make it law. However, some of these could be retroactive this year. The other thing, Tracy, I think that is important for people to think about and understand when it comes to changes like this is, many of these changes may not affect our viewers, or just a portion of the changes could affect them. So, the increase in taxes right now with the Biden proposal, he's made it pretty clear that he wants to raise taxes for those that are $400,000 or more in income. So that obviously minimizes the amount of people that it impacts. However, one of the things, Tracy, that I wanted to point out is I've got this graphic here that we'll take a look at, and it shows the tax rate comparisons. And it looks at 2010 versus 2021 tax brackets. And you can see that we had a 28% bracket in 2010 that actually started at $137,000 of income. And today, our 24% bracket doesn't start to $172,000 of income. So, I've said this for quite some time that we are historically low tax brackets. In fact, 40-year lows. And so there is certainly bound to be some changes, especially with everything that's gone on with the pandemic and all the money that has been spent.
Absolutely. It always pays to take the time to do your research and ask an expert before making any assumptions about things like this. We keep hearing about capital gains tax and how we could potentially see a significant increase in the rates as a result of Biden's proposal. Eric, would you mind clarifying for myself and our audience exactly what are capital gains taxes?
Yeah, so capital gains taxes are there's short-term capital gain and there's long-term capital gain. And so if you have assets that you own, whether that's a stock, a bond, a piece of property, and you sell it for more than what you purchased it, there could be capital gains that you pay. And you have to have more than $80,000 of income to even be affected by capital gains. So a lot of people don't even have a capital gains tax. Short-term capital gains is less than 12 months. So if you own something less than 12 months, that's short-term capital gain. Long-term capital gains is more than 12 months, and there's a lower rate. And so this is certainly a big discussion on the Biden proposal.
And why are capital gains taxes lower than other income? And since in order to be required to pay capital gains taxes, well, you have to have enough money to invest in assets to begin with. So could you say these really have a bigger impact on the wealthy?
Well, I'd say on the wealthy, but, we see a lot of people that wouldn't, be categorized as the wealthy have assets as well. So this could come into play as an example, farmers people that have land. This could be a big issue as it relates to capital gains. In fact, I have a graphic that really lays out the capital gains. And so if you look at this, it shows the ordinary income rates. So you can see the ordinary income rates there on the left, and then the capital gains on the right. And so, somebody right now that's up to the 32% bracket, their maximum capital gain is 15%. And Tracy, you asked why lower capital gains rates? Why is this? Well, capital gains rates used to be the same as ordinary income. And the thought here of lowering capital gains rates was to encourage investment, to encourage people to, buy property, stocks, bonds, and so forth, and be able to sell those at a lower rate. It was kind of to help fuel the economy.
That makes a lot of sense too. What are the current rates for capital gains taxes?
Yeah, so if we refer back to this graphic, you can see that it's basically pretty simple. 0%, 15%, 20%. And those are long-term capital gains. So if someone has that under $80,000 of income and they sell something for a gain, they're going to have zero taxes. That's zero. So this is an area of opportunity for those out there watching, because you may be able to sell some things today that have zero tax impact. Somebody that has a 15% cap, it's not as high as their ordinary income rate. And so one of the discussions is, if things change with capital gains, will it revert back to the beginning of this year? Or will it be effective next year? Now, they could make it the beginning of this year, so they could make it retroactive. So this is one of the things that we're really not sure of, and we'll find out more here over the coming months as this discussion continues.
Thanks for clarifying all of that. Now, another thing we all worry about is Social Security. If Biden's plan is implemented in its current form, where will we be with that? The president has pledged to make some changes that would prevent the expected budget shortfall in 2028. The outlook regarding the future of Social Security has, of course, been bleak in recent years. Could that be changing?
It could. Now, those that are drawing Social Security or planning Social Security, there can be some changes here. I don't think it's any hidden item that Social Security at some point is going to be underfunded, and we're going to need to make some changes there. So some of the changes that we're talking about is, number one, how they calculate increases in Social Security. So you do get increases in Social Security. If you're receiving Social Security now, that you get increases. That's right now calculated by an index. And the Biden administration is saying that that's not the correct index. We need to change that index to really reflect a retiree's more what they need. Now, last year, Tracy, if they would have used that new index, it would have increased the benefit by 0.2%. So it's not a huge lift, but that's a big deal. The other thing that they're talking about is, if you've been in Social Security for 20 years, you're going to get a 5% bump in your benefit. And that'll start in the 16th year by going up 1% a year by the 20th year. So that's another factor. They're also talking about raising benefits for surviving spouses by 20%. So that's a big factor. So right now, the way it works with Social Security is, if you have a husband and wife, one passes away and they both were drawing Social Security, the remaining spouse takes the higher benefit. So they're talking about bumping that. The other thing they're talking about is a benefit of raising the minimum benefit 125% above poverty level. So those that have lower Social Security numbers, they would actually have a benefit that would be 125% above a poverty level. You may have heard this statement, kind of lift more people out of poverty in retirement, and that's what it is. So there's other benefits as well. And what's really going to be important, Tracy, is as we see this come about and determine, what happens and what doesn't, which we don't know, but people that are planning for Social Security, it's going to be a huge factor. So let me give you a quick example. If someone plans on taking Social Security early, that reduces their benefit. Well, if they do happen to get through, they're going to give someone a raise starting in the 15th year, 16th, 17th, 18th, 19th. Well, 1%, right, of a lower number is a lower number. So if they take their Social Security early, they're going to penalize themselves that day, and they're also going to penalize themselves down the road.
Years from now.
Years from now, because a lower number is a lower number. So these things are going to really need to be determined and watched and planned for once we know what's going to be law.
Very interesting, Eric. Now, it seems when COVID took over, everybody forgot about, our country's issues with Social Security for a while. And it's good to hear that benefits could be increased without having to cut other benefits. But what are the drawbacks to this plan? I mean, who will be affected by them the most?
Yeah, so paying for them. Yeah, that's one of the drawbacks. It's how you're going to pay for it. And, it's been talked about how are we going to pay for it. So we definitely think that there needs to be some changes. So a couple things here. One is that up to about $142,000 is where somebody pays into Social Security. So beyond that, they don't pay any more into Social Security. They continue to pay Medicare, but they don't pay into Social Security. So what Biden's proposal is that anybody that's over 400, and you're going to hear this 400 number a lot within the proposals, but anybody over 400 now needs to kick into Social Security. So let me explain it in this way, that somebody that's making $142,000 is capped at how much they have to pay into Social Security. They're paying in the same amount as Jeff Bezos, the founder of Amazon. So, is that fair? I don't know, but the new proposal would be that Jeff Bezos would have to pay the 142 limit. Then there's a gap between 142 and 400. And after 400, they'd have to pay into Social Security. That's one option. The second potential is they could delay Social Security further. Full retirement age right now, if you're born after 1960, is age 67. They could delay that further, okay, to say full retirement age is age 68 or 70, okay? That's another piece of it. So there's multiple different ways. What we think is there's not one solvable solution. It's got to be pieces from a couple different areas to really help make sure that Social Security is really solvent going forward.
Absolutely. Well, Eric, I have a couple of other questions I want to ask about the president's infrastructure plan. But first, it seems so many of our viewers are affected by at least one of those issues we've discussed over the last few minutes. And let's face it, it really helps to get as much advice as you can from someone who specializes in this like yourself. Getting a second opinion from a trusted fiduciary advisor can help somebody really bridge that gap between, what they know and the complex financial industry, can't it?
Yeah, it really can. And what I think is really important, Tracy, for folks to understand is, you want to get an opinion or advice that's not based on product sales. We're not mentioning any products, and the Biden administration and all of these changes are not product based. It's advice based on tax situation. The other piece of it is that many advisors, unfortunately, for the firms that they're affiliated with, cannot specifically talk about tax and tax strategies. Well, this is a huge part of one's financial life, is taxes. How much they're going to owe now, pay now, how much they're going to pay in the future, and what's the plan to reduce it. So we're offering up a second opinion. They can schedule on our website, or they can call the number on the screen. And it's really hard to get a second opinion from the advisor that gave you the first one. So if your current advisor is not talking about these things with you and proactively starting to think about them, it may be time for a second opinion.
Absolutely. And Eric, just a couple more questions about the infrastructure plan. Let's get back to that for just a moment. Unfortunately, this new legislation means that estate plans will be affected, which is something that most people aren't really very keen on discussing. Nevertheless, if you want to make sure your family and your legacy are taken care of, you have to stay informed. And last month, we discussed the step-up-in basis that resets the costs of estate items. There's been a lot of talk that the Biden administration could be looking to remove this. What changes do you think we can expect with estate planning?
Yeah, so this stepped up basis thing, I think, is one of the really big pieces that could affect a lot of folks. And so right now, and again, just to kind of go back and remind folks, is a stepped up basis means that if I bought a stock for $10,000 and it's now worth $100,000, I have a $90,000 gain. If I sold it, okay, $90,000 gain, and where my tax bracket falls is my long-term capital gain if I owned it more than 12 months. If I pass away and I pass it on to my beneficiary, they could sell it the next day for $100,000 and pay zero in capital gain. And stepped up basis means they'd simply take their basis, what they paid for it, as the date of death value. Now, with the Biden proposal, they are not fully eliminating it, but what they're saying is anything over $1 million, okay, would then be a stepped up basis would be eliminated. So under $1 million, you'd still have stepped up basis. They're also saying that for primary residence, you could have $500,000 a gain in a primary residence. And people may say, okay, $1 million, no problem, I'm not going to be there. Or they may have all IRA money, Tracy, because that doesn't count for IRA money, okay? Doesn't count for Roth money. We're talking about assets that are not in retirement plans. But one of the things I want to point out is we're really concerned about property owners, farmers. So if you think about a lot of folks that have property and maybe even inherited it from their parents, okay? I have a lot of farmers that bought land for $1,000 an acre, $1,200 an acre, and it's worth $14,000 an acre. So we're talking about, from $100,000 up to 1.4, 1.5, $2 million. So they paid 100 and now it's worth $1.5 million. That's 1.4 million. That first 100,000 or million could get excluded if that's what the proposal, if it becomes law. 400,000 subject to tax. So it's going to hit more people, I think, than even what they realize. And so we're keeping a real eye on this because there's some potential maybe you could do before the law changes. We'll just have to see what comes.
Wow. Key information, Eric. Thank you. Who and what kind of items? And I guess you did mention a lot of them there. Are there anything else? You mentioned farmers and their land, but anything else that could be affected by the step up basis?
Sure. Yeah. Business owners. So if they own business, right? Property. So, what kind of property, they own property. So that's big. A lake house or cottage or something that was inherited, so there's families that owned and inherited a, house that sits on a lake. Anything that's that appreciating type property. And I think people will hear this million, well, I'm good, but they really don't think about, when you total it all up, it could equal more than that. So I think those are the things to really keep an eye out for.
And while we're on the topic of estate planning, Eric, there are rumors swirling about the federal estate tax exemption being dropped from the 11.7 million it is now to 3.5 million. Can you explain what this tax is all about and some of the history behind it?
Yeah. So what this is that an individual now can pass an estate on, upwards of, under 11 million, and there's no federal estate taxes. And actually, not too long ago, 2002, the federal estate exemption was $675,000 in 2002. And so what we did back then is to get an exemption, if we had a married couple, we could establish a trust, an AB trust, that each of the individuals, the couple, each of them would get the exemption. So for example, today, if you did this and established a trust, each would have 11 million, or combined, they'd have 22 million. Well, they're talking about dropping this back to potentially 3.5 million. Okay. Now, you may say 3.5 million, that's still a lot of money. What I want to remind people on is we just talk about property and property value. Okay. There's a lot of people that may have a net worth that they just don't realize they have. We've talked in this show, Tracy, that more people save money through retirement plans. So they have larger amounts. They have larger estates, because before they had a pension, they didn't really have a retirement plan. Now we're saving through retirement plans. So that's a big deal. The other thing to remember is life insurance counts. So if somebody has $1 million of life insurance, that's counted in the estate. So, somebody could have a house, some assets, retirement plan, some property, and life insurance, and they could be at the 3.5 million. Now, we haven't seen really what those rates are going to be, but I will tell you that those rates could start probably in the mid 30s and go up. So remember, that's not income taxes. There's still income taxes due on retirement plans. Okay. If it's a pre-tax retirement plan, then the beneficiary must have withdrawn it, okay, out by the end of the 10th year. There's still taxes on that. This is different. This is not income tax. This is estate taxes. And so I think that this is also an area that we definitely want to keep an eye on, and people may need to revisit their estate planning strategy.
Yes, what valuable insight, Eric. Thanks. And again, you mentioned it. We're committed to giving folks accurate information. So it's important to note that none of these things that we're discussing are set in stone. They're just part of a wider discussion right now. And also there will be much more talk about this infrastructure bill and the possible changes it could bring in the months ahead. But in the meantime, what are some steps our viewers can take to prepare now?
Yeah, so very important what you said. I mean, none of this is law. We're going to keep people updated, so kind of stay tuned. And really what they can start thinking about is, do they have highly appreciated stock and so forth? Is there some strategies there? So we're looking at, some people can sell and they're not paying any capital gain. That's important. Their estate. So they need to start thinking about their estate, because if those things happen, we want to make sure that their estate is proper there. Okay. Also, if they can still itemize, are there things that they can do to kind of bunch up deductions and so forth. And if they own a business, we haven't even talked about that. There's a whole nother level of potential tax law changes for business owners depending on your structure. So you need to have a heightened awareness there. So I think it's understanding, and they don't need to dig really deep, but get a just kind of a high overview of their situation and what's kind of being discussed. And then as we get closer and things start to, maybe decisions and laws are changed, then we need to kind of act on it.
Yeah, take a deeper dive. And as Eric said, it is just a great time to take advantage of the second opinion offer Eric talked about earlier. You can reach out to Hilltop Wealth Solutions at any time. We are out of time for this edition of Your Wealth Health. For Eric Brenner and the entire Hilltop staff, I'm Tracy Capelman. Thanks for watching, and stay wealthy, everyone. We hope you found this discussion helpful today. Don't forget to like and subscribe to our channel for new content weekly.